Please give it up for Axios business editor and author of Pro Rata, Dan Primack.
Good morning, everybody. Welcome to New York City this morning. I will get New York right. I was in San Francisco last week, and I welcomed them all to New York. So, New York, good to see you. I was way ahead of my time, apparently. And welcome to our cross-continental private equity event. And when I say cross-continental, I'm not suggesting you all need to get on a plane tonight. But we are doing this here this morning to talk about the private equity markets. And then we have an event tomorrow night in London, co-hosted by my colleague Lucinda Shen with senior executives from KKR and Apax. Huge thanks to our sponsors, Weil, without whom I see most of you are eating and drinking things. You wouldn't be. If they hadn't done this, you wouldn't be. You'd be hungry and you would be super thirsty. This morning, we are going to speak with New York Stock Exchange President Lynn Martin. We are going to speak with Eric Hirsch, who is the co-CEO of Hamilton Lane, and with Eric Liu, who runs private equity in North America and healthcare private equity for EQT. We have a lot of stuff to talk about, so let's get to it. Please welcome Lynn Martin and the New York Stock Exchange. Hey, good to see you.
Good to see you. Thanks for having me.
Absolutely. So, Lynn, when folks like me think about where you work, and I know you do a lot of stuff at New York Stock Exchange and at ICE, and we'll talk about it a lot, but we think IPOs a lot. From where I sit, the market feels like it should be strong. Public equities are high, outside of even the Magnificent Seven.
Yeah.
Most of the companies that have gone public over the last few months have priced well and traded better in the aftermarket. Yet there still seems to be a dearth of IPOs. Why?
Okay, so a couple things in that question. Yes, you're seeing the equity markets do incredibly well. Dow crossing 40,000 on Friday, which happened to coincide with our 232nd birthday. It's a great sign, right? It's a sign that there's a lot of confidence in the equity markets. I think it comes down to some companies had to go first. Some people had to be the first ones out of the gate in 2024 to really reopen the markets. Now, if you think back to 2022, 2023, you saw the IPO markets attempt to reopen and then shut, attempt to reopen and shut a couple of times, particularly last year. Now, what you've seen in this most recent round is companies go, most meaningfully. We had a couple of IPOs per week, 2 major IPOs, I would say major in this market, IPOs per week, figure around $500 million to $1 billion in capital raising during the month of April. People wanted to see how those companies did. They were across multiple sectors. You saw industrials with a company such as UL. You saw tech with companies such as Reddit and Rubrik. You saw consumer with Viking Cruises, a few others. So multiple companies had to go out. They had to do what you all want in the IPO markets, which is upsize, price high end of range, and trade well in the secondary market. All 3 of those criteria, if you think about the companies that went in 2022, 2023, you didn't have all 3. This quarter, you have had all 3, and I'm going to count Reddit as part of this quarter, even though they were the end of March. You have had all 3. You've had the upsize, you've had price above the range or at the high end of the range, and you've seen them do well in the secondary market.
And I appreciate that the numbers this year are higher, say, than last year or in 2022, although that's kind of damning with faint praise, right? Because those years were horrific.
Right.
Why are we not seeing a boom? Like, you've got a huge number of privately held, both VC-backed, private equity-backed companies that theoretically in prior eras would be doing it now.
If you take 2 steps back, in a normal year, the U.S. equity markets raise about $45 billion, $46 billion. We've raised $14.3 billion to date. We're not that far off from a quasi-normal year. And we're working with a variety of companies in the pipeline who are now that they have the confidence, now that they've seen what companies who've recently gone out have performed at, they're making plans to go in the second half of the year. The caveat is the election. So that's the caveat. I would say we would have a normal year. We're on pace for a normal year, not 2020, not 2021. Leave those at the one end of the tail. 2022, 2023, the other end of the spectrum. But we're on pace for a normal year if we didn't have the election.
When from your perspective, not when does the election start? We know when it technically starts from an electoral standpoint. But in terms of companies being fearful of trying to price into the election, what's that line of demarcation?
I'd say it's probably October.
It's October.
Middle of October.
I've heard an argument a little bit more on the deal-making side than on the IPO side, that the election might not matter as much this year in terms of scaring people off from doing deals, because you've got two candidates who have been present before, so they're more known quantities. Is that a good argument? Is that a legitimate argument? Or you think still people know once October comes, we're done?
I don't know, because in this election cycle, it's expect the unexpected, right? It feels as though if the market under the current administration continues to do well, the market in the previous administration did well.
And it did well after the election.
Correct. And typically in a year post-election, the S&P grows 12.5% in an average.
Isn't that another reason why more companies should be filing and getting ready to go? Like
the only thing that the companies are going to put a slight pause on, and I don't know if it's going to be slight, long, I don't know, is there's going to be noise. There's going to be probably some volatility in the market around the election, so it might just be a little bit challenging to explain to your next group of long-only investors, if your stock moved around, what was noise and what was really fundamentals of your first couple of weeks of trading.
I'm going to ask you to generalize something that I know is very specific and unique to each company that considers going public, whether it be on stock exchange or somewhere else. For those that are owned by private equity, since it's a private equity event, how much of the hesitancy do you think is coming from the C-suite compared to from the financial sponsors?
It's hard to say. I think the sponsors want to get some companies out because they want to have some exits so they can raise the next group of funds. I'm not telling you all something you don't know, especially if you've had something in your portfolio for a long time. You got to show some exits at some point. Companies have had a little bit of fit and start, in terms of their IPO preparedness. And I think some companies are considering, well, do I have to be profitable or not profitable? That's been a big overhanging debate, which again, it comes back to the success that companies have had over the last, call it 6 weeks in the market. You look at a company like Rubrik, who was operating at a loss, great growth.
Reddit, major loss.
Correct. And you look at how well they've done in the market. I think they priced at 33, now they're trading at 62.
Is the key, when you look at something like Reddit or any of these companies really, is the key that you have to have a legitimate AI story?
I don't know that it's that. I think you have to have a very clear investment thesis. You don't have to have an AI story.
Do you think you can go public right now without an AI story?
It depends on what you mean by an AI story.
I mean a story. It doesn't have to be real. I mean a story. You have to be able to answer the question. When the institutional investor stands up or sits up in the meeting and says, how are you going to incorporate AI into your sandal making company? You have to be able to explain how you're going to incorporate AI into your sandal making company.
The good news is a lot of companies are already including AI in their sandal making company, even if it's around customer analysis, things of that nature. But if you look at a company such as Reddit, for example, they've had good growth because since they've IPO'd because of the deals they've done, because they're a data company. And if you come back to, at the core of AI, it's all about good data. That's something that we firmly believe in. It's why we've been in the AI business for about, not the AI business, but we've leveraged AI for more than a decade at our company.
And I'm going to ask about that in a second. One final question just on this, which is, given that there's a kind of a glut of private capital now, and for a long time, obviously, private equity firms sell companies to other private equity firms. But even on the kind of younger side, you have a huge amount of growth equity, and Stripe's a great example, right? They should have been public forever ago. Instead, they just keep getting billion-dollar checks from growth stage firms so they can give tenders to their employees. They don't have the internal pressure. What is the most succinct argument right now you would give to a strong company CEO for going public, as opposed to take the check from the growth equity firm and stay private and don't have the scrutiny?
Well, what we always talk to CEOs and C-suite about is go public when you're ready. I mean, the fact is nothing really beats the public market in terms of efficient capital, as well as, so you point out the ability to reward your stakeholders, but democratize investments. Also, if you're looking to do large M&A, the M&A currency that you have when you're a public company can do M&A with stock, you could do it with cash, you could do it with a combination of different things. That's the main driver.
You mentioned the election and kind of call it political uncertainty. Let me ask, kind of broaden that to geopolitical uncertainty. Do you feel that the fact that we have an election coming this year, has that restricted at all the number, from your perspective, number of foreign companies that are interested in listing in the U.S., particularly coming from China? I mean, I think of Shein, obviously, which you guys have been competing with London for. Has that increased the pressure or the difficulty in certain companies coming here?
I think that there's always, a very focused regulatory framework. Now, keep in mind, the last couple of years, there's been additional clarity on the regulatory framework and the way that a company, for example, a company based in China, comes out to the U.S. market. We just had a EV company, a company called Zeekr, IPO on us on May 10th. And there's a process now. 2.5 years ago, there was not a process. You had to get government approval from the CSRC. You had to get government approval from the U.S. You had to submit to a PCAOB audit. If I think back to 2.5 years ago, if we were on this stage, or 3 years ago on this stage, you would have asked me about China delistings.
Yeah.
It seems like we've moved past that.
If Shein wanted to come to the exchange, would you welcome it?
If Shein wants to come to the U.S., of course, we will welcome any company that would be welcome.
When you're competing with London for deals, since it's a cross-continental event, the trading tax that is on companies that go public in London, from your perspective, how much of a competitive advantage is that for New York?
We typically focus on the fact that our liquidity pools are the deepest, strongest in the market, and that continues to prove itself time and time again. It's why we've been able to attract a variety of companies to move out of Europe and the UK over to the US for a primary listing. Most recently, Flutter.
Which is the FanDuel parent.
Yep.
I want to make sure I get this quote. You did a TV interview recently, let's go back to AI, and you said AI is, this is your quote, just the next generation of a data-driven trend in terms of increasing transparency, driving down costs. You obviously come from a tech background, not tech executive, but tech background. So do you view AI as iterative from a tech perspective or revolutionary?
I think the fact that we're all talking about AI so much and thinking about AI so much is the revolutionary piece. I think it's evolutionary from a technology standpoint. If I think about what I studied in school, the concept of neural networks, it's just it's the next generation of that. But the fact that even your mom will talk to you about those two letters
As
at
in,
the moment
what does it mean is what it says, yeah.
And are you using it, and is it good or is it bad?
Do you still have a job? Are you still employed?
Right, exactly, yeah. 20 years ago, that wasn't a topic.
So, okay, you talked about how your company's been using AI for a while. From a practical, tangible standpoint, what is the biggest innovation at, say, ICE or the exchange that AI has enabled, something you wouldn't have been able to do otherwise?
So one of the things that it hasn't, two things, because I'm going to approach it from the revenue generating and the cost perspective. From a cost perspective at NYSE, we use it to power our regulatory surveillance systems. If you take a step back, we receive 750 billion incoming order messages every day. Buy, sell, trade. Those are just the three messages I'm characterizing. We can't surveil for nefarious activity and achieve our obligation as an SRO unless we have a machine helping us make sense of all of that input. So it's enabling our humans to do more efficiently with the voluminous data sets that continue to exponentially increase. On the revenue generating standpoint, we have been using large language models in our proprietary chat platform to add transparency.
Your own LLMs, ones you guys have developed yourselves?
Correct. To power our energy markets on the ICE side of the business. The energy markets in various parts, the more esoteric parts of the market, are still very opaque. They're not, a standard buy sell that you would see. It doesn't look like a U.S. equity. Much more complex, particularly when you look at the various differences between the hubs, the delivery points for energy. We've been using large language models in our chat platform to detect if I'm talking to you about water or if I'm talking to you about a potential trade idea. If we detect a trade idea, we push in some high-level analytics, which help you determine fair value. So what our view of fair value is, but also if you're an options trader, you've got a variety of Greeks that we plumb in to give those people who are having that conversation about that trade idea additional transparency about here's where we think the market is on that. And then as you continue your negotiation in this more
Does it
opaque
hallucinate
market,
ever?
no, because it's very much driven off of the conversation we're having and adding an efficiency tool. So if we agree a price,
Yep.
it will allow you to very seamlessly just click on it and then send it to our trading and clearing houses.
Final question. On Tuesday, there's going to be a change to kind of how all trading gets done, which is
T+1.
T+1, one fewer, T+2 was 2 days to settle, now down to 1. This feels a little bit like the conversation before Y2K, and a lot of people a little freaked out about what's going to happen on Tuesday. How are you feeling about it right now?
The good news is we've had a long time to prepare. The industry has had a long time to prepare. We've been in close contact with our clearinghouse, who is the main epicenter of this change, DTC. Touch wood, we're feeling okay. We feel as though we've been prepared for this. But as anything, we're prepared for if there are challenges on Tuesday, how we handle them.
And while you've been preparing for it and you've been able to kind of basically have the time or make sure that time is have, has there been in the back of your mind a little bit like, well, if we could do T+1, there's no good reason to not be T+0?
It is, in my mind, the next evolution of the markets, but you need to appreciate the infrastructure around the markets. So while in this digital age, you might say, yeah, well, why are these things settling on T+2, T+1? Why isn't it an instantaneous settlement? You've also got to appreciate the different parts of...
But you think at some point in the future we'll get to instantaneous settlements?
Potentially, potentially.
Lynn, thank you very much for your time.
Thanks for having me.
Appreciate it.
Introducing our View from the Top moderator and Axios publisher, Nicholas Johnston.
There it is. Good morning, good morning. I'm Nicholas Johnston. I'm the publisher of Axios. Thank you so much for waking up this morning. I love doing these kinds of events. There's a live manifestation, I feel, of our journalism. It gives us a chance at Axios to see all of our readers that are actual people, and it gives all of you a chance to see that Dan Primack is not some large language model just trained on private equity transactions. So thank you so much for waking up and joining us this morning. Also, nothing that we do at Axios would be possible without the support of our partners. So we're hugely grateful to Weil for making this possible. Not just this possible, this is the very first thing for us, a true transatlantic, transcontinental event. We're talking private equity this morning in New York. We'll be talking about it tomorrow evening in London, which is, I think, is an awesome framing for this kind of conversation on a topic like this. And so I'm very excited to welcome for a View from the Top conversation from our friends at Weil. Christopher McCara, the head of U.S. private equity at Weil, and Rob Rizzo, a partner in the private equity practice. Rob and Chris, come on up to the Axios stage. So this is maybe a jump ball for both of you guys. I want to start a little bit more about the framing of this. Tell me why it is so important that a conversation on private equity should happen on both sides of the Atlantic, in New York and in London.
Yeah, I mean, speaking for Weil Gotshal, you know, for us, the private equity practice really is such an international practice. We've been in London since 1996, which I looked up before I came on stage. Our London office was built on our private equity practice. We have a ton of clients who are European clients who have come to New York and vice versa. And you know, I don't have the metrics to back this up, but it does seem to be accelerating over the last few years, especially with European clients coming into the US and penetrating that market, whether it be through an organic build, importing people into New York, or through acquisitions. Obviously, that's a huge trend right now as asset management, M&A. We're working on a few now, which are European managers acquiring US managers and vice versa. So that's always been a huge part of our practice, and I think it's a trend that's going to continue.
I think it feels like the framing of the conversation is you can't do either or. If you're doing this conversation in New York, it leads to London and vice versa.
Right. I think it's hard to have the conversation about the U.S. without Europe and vice versa. There's just so much connectivity across the Atlantic these days when you look at private equity. In particular, there's been a huge shift of capital coming this way from the European sponsors. Europe is smaller than the U.S. It's a little tumultuous at the moment. So we're seeing a lot of sponsors look to the U.S. and to our markets and to our targets when it comes to private equity and other acquirers.
Yeah. So let's dig in a little bit deeper on some important issues on both sides of the Atlantic. The regulatory regimes and antitrust. That's hugely important to the type of works you guys are in, and I think it's a very top mind of regulators on both sides of the Atlantic. Give me a sense, Rob, maybe of your view of what it looks like from each side.
Sure. I mean, we're dealing with the same issues on both sides of the Atlantic, and the regulators are extremely virulent these days. We're seeing hostility like we've never seen before when it comes to deal making and private equity. But the important thing to note is that the governments, both in the U.S. and in Europe, continue to suffer loss after loss when it comes to private equity and the deal making and our sponsors and what they're out there doing. Private equity is pro-competitive. We are looking to enhance the competitive nature of the markets, and everything that private equity is doing in acquiring businesses, seeding businesses, is furthering that goal.
Right, but I don't know if regulators view it like that, but it feels like the regime is what the regime is, and you guys have to figure out sort of how to make that work.
And I can just tell you also anecdotally from a law firm management perspective, when you look at the areas of growth, obviously private equity is one of them, but antitrust, regulatory, we just hired someone from the SEC. We've actually hired a couple people from the SEC recently. I interviewed someone on Monday who's with the FTC. So you just follow the lateral hiring, and you can see where.
I don't want to get too promotional, but in a tight regulatory regime, I guess you should probably have pretty good lawyers.
Yes, we have good lawyers. That's an important.
Let's take a step back from the regulatory. Maybe stay with you, Chris. Can you just give us a sense of what's the state of the market right now? How are things looking?
Okay, so I will caveat this by saying I am a hopeless optimist and a very glass is half full person. Coming into this year, I'm on record as having called the bull case for 2024, which we're all going to forget about if that doesn't happen. But a few things. Obviously, the financing markets have normalized. Higher rates for longer definitely has put a little bit of a pallor on the deal making market. But just the fact that if you look back a year ago from today, the financing markets are, in an incredibly healthy place, and you look at refinancings, and I think we're getting more calls right now on refinancings than we are on new deals. But that being said, I think even just over the last few weeks, we're getting more calls on new deals, and not just minority deals and some of the minority recaps and sponsor secondaries that were happening during 2022 and 23, but really proper LBOs. We're seeing auction processes that are actually leading to signed deals, and not just that, which is particularly encouraging, is I've represented some sponsors in processes recently where some very smart people were very surprised at the multiples that these businesses were trading at. There's a client had used the phrase non-economic multiple when describing.
It sounds like a win.
And Lynn and you guys were talking about it earlier, but there are people who just, professionally for purposes of fundraising and other reasons, just need to put money in the ground. And so my impression is I think sponsors are starting to see, some of those sponsors who are on the buy side who lost out on a business, they're saying, okay, if that business went for 15 times, I've been sitting on this similar company, let me go see if I can get 14 or 15 times for it. And again, like Lynn said, it's not breaking news, but once private equity sponsors start to sell, it's going to have a flywheel effect on the overall market. So it does feel like that's starting to happen. And across the spectrum also, you are starting to see some private equity sellers in the market. We did the SRS Home Depot deal, which was an $18 billion deal, which obviously was a very positive development for the market. People are looking at take privates. We're getting calls on carve-outs. We are still getting calls. There's a lot of 50-50 sponsor secondaries, which is, we'd like for those to become full auction processes for our sponsor clients in the audience. Like full sales would be better than those 50-50 deals. But yeah, so it's the momentum feels like it's there.
I mean, like, look, equity market is starting record highs. It feels like everyone's gotten used to what rates are for now. So, like, spin this forward. What are the next 6 or? I mean, you're a positive guy, so I know where this is going. But give me the next 6 or 12 months.
Yeah, well, the first is, and we definitely have been talking to sponsors about the election, and I think Dan had mentioned that, you know, what you'll hear people say in the private markets is that the election results are less important. That is consistent with what we've heard as well. There's not a fiscal cliff issue. There's not some huge tax changes that are happening. And in preparation for this, having spoken to sponsors about the election recently, what we're hearing is it's really not going to affect the way that they approach the rest of the year. I was talking to one of my capital markets partners yesterday who was saying that his view is like in a few months the public markets will open up as well, and there's definitely, once you have the public markets going and people feel comfortable with IPOs, I do think that has a virtuous, maybe not animal spirits type thing, but there's, people are reading the Wall Street Journal every morning, and if the vibes feel good, it's going to accelerate, and so we see
Good
that
news
happen.
lawyer. Are you going to give us the bad news?
No, not at all. I'm going to give you the better news. Look, the fact of the matter is, yes, things are a little bit chaotic at the moment. We have 2 wars going on, and that's terrible, of course. Interest rates have plateaued, it would appear, and we hope if they come down, I think that's just going to give us a turbo boost. But the fact of the matter is, everybody's gotten comfortable with, I'll borrow a phrase from COVID, the new norm. People understand what financing looks like, and there's a lot of pent-up energy in the deal-making community. There's a lot of sponsors that need to show returns before they go out and raise their next fund. So everything is primed for a huge uptick later this year into early next.
All right, 2 glass half full guys. Before we get the hook here, I want to end on Axios Sell on one fun thing. There's a handful of us on the room that are on the 10 p.m. to London tonight. I think, Rob, you get this softball. Give us one fun thing to do in London. What should we not miss when we get there?
Okay, so in a city of great pubs, I will plug one. It's called the Pelican. It's in Notting Hill, and it is a fantastic establishment that I would encourage everybody to check out.
Are you going to disclose that it's owned by one of our partners?
One of our partners.
All right, full disclosure.
One of our partners has a small stake in it.
Yeah, small stake.
Right.
The Pelican.
Right.
So just make a note of that if you go to the Pelican. Chris, Rob, thanks so much for being here. Huge thanks to Weil for making this conversation possible. Let's get Primac back up on stage.
Here he is again, Axios business editor Dan Primac.
Hello, thank you for still being here. I appreciate it. I'm really excited to welcome our next guest, who I have known I've been doing this for a long time, and I have known him for most of the time I've been doing this. He is now the co-CEO of Hamilton Lane, which has incredible insights into everything private equity, private credit, fund-to-fund, secondaries, et cetera. Please welcome Eric Hirsch. Thanks for joining us.
Loose light bar stools, nothing more comfortable.
They are, well, absolutely. Do you want a drink? There's somebody in the back.
Exactly.
Okay, I want to just quickly follow on the last conversation I had up here with Lynn Martin. We were talking a lot about IPOs, which is a way that some private equity firms exit their companies. It is not the primary way at all. As somebody who kind of oversees this vast universe of alternative assets, do you care much if the IPO market is strong, weak, or third way?
I care, not because it's a great source of exits. It's not, speaking as a public company. If you think about holding periods, so they're getting longer. We're paying more for businesses. The economy is a little bouncy in places. And so you're sort of seeing holding periods for companies stretching out to about 5 years. If your exit is then an IPO, you're going to then be in that for a while. So a lot of people don't love that as an exit channel. That said, I prefer a strong IPO market because I think it's indicative of a better economy and just a better exit environment in general. So given the choice, do you want a strong IPO market? My answer is yes, because it sort of belies better things, not because that's the best path for liquidity.
There was this old private market maxim that I got taught when I started covering private equity, which was that the private markets follow the public markets on a little bit of a lag, in everything from deal activity to valuations, et cetera. Is that still true, do you think, or are they legit decoupled at this point?
I don't think they're decoupled. I mean, fundamentally, they're both equity, and fundamentally, both of those markets have an emotional underpinning to them. How do I feel? Is today the day I want to buy that company? Is today the day I want to sell that company? Is today the day I want to go public? We like to say that's all analytical, and certainly the fund managers want to tell you it's all analytical. It's not. There's a lot of emotion sort of built into that. And so I think we're watching the stock market, we're looking at our own portfolios. I think all of that becomes intersected, and equity is still equity.
I'm curious, one of the big things that Hamilton Lane is trying to do is kind of expand the universe of private equity investors. I don't mean professional investors, but people who are able to invest in the asset class, kind of within what you call the mass affluent. Why do you think that call it cohort of investor has really lagged institutions so far and continues to, even over the last couple of years, your efforts, Blackstone's efforts, et cetera?
Yeah, I think it's all about access. I mean, if you think about it, if you're here, you follow the private markets, there's really no debating that the private markets from a performance standpoint have just been fundamentally, significantly, substantially better than the public markets. Pick the timetable. You go like in the last 20 years, I can find you about an 8-month window where it wasn't true, and other than that, it's true. And so people know that, and I think as data gets more and better understood by a wider audience, the private investor, the retail investor, wants access to what the institutional investor has had for a long time. The issue has been how do they access it? And there hasn't been great fund structures, or they've been prohibitively expensive, hard to get into, you had to have a banker, you had to have this. Yeah. That playing field is simply just getting more leveled, and I think over the next couple of years, you're gonna see it get massively more leveled. Technology will be a big driver of that, and so I think you will very quickly see that retail investor kind of catching up to the institutional investor.
Are you seeing it? Are you seeing it catch up? And I wonder, when you talk about how if you look at the data, if you look at the benchmarks, the one area that's almost never true, and that's partially just a byproduct of how private equity works, is those one-year numbers. The one-year numbers always seem to be much worse for the private markets than the public. Does that play just an emotional role if you're an individual investor looking to say, yeah, but over the past 12 months, it's been bad?
Yeah, I think there is an educational part to all of this. But I do think that we're worrying, I think, as a society, a little less about duration. People are saying, and getting more rational, if I'm saving for retirement, do I need all of that to be liquid daily? That doesn't make a lot of sense. And so I think the willingness to kind of lock up some capital and to think longer term and to look at longer term numbers, 3, 5, 10, 15, 20, 25, I think is sort of moving them. So when you combine education, access, better technology, better cost structures, I think you're just going to see the inevitable. And we're seeing it already.
When you talk to your clients, whether it be institutional or individual, but more on the institutional side, there's been such a massive growth in private credit over the past several years. Are you still seeing interest in private credit kind of, even though I know the sheer numbers aren't necessarily matched up, but kind of new interest outpacing new interest in private equity?
The interest is there. I mean, private equity still is the dominant part of the asset class, and I think that will remain that way for maybe forever. Private credit continues to be of interest. The spreads between public credit and private credit, despite rising interest rates, continue to be relatively wide. Private credit market continues to be inefficient. And I think all you're seeing is just a shifting of the banking resources. So we went from if I owned a small business in Albuquerque, I was getting banked by a regional bank in my sort of geographic zone. That by and large is falling away, and what has sort of replaced that has been private credit managers. Are there too many of them? Yes. Are too many of them relatively inexperienced and haven't been through enough cycles? Yes. Are we going to see some fallout of the private credit managers? Yes. Are we going to see some consolidation of them? Yes. Do I think the interest is going to wane? No.
It's interesting you say consolidation, because one thing we've seen on the private credit side is a lot of big alt asset managers have obviously launched, some of the first to launch major private credit groups. Do you think the consolidation is going to come by them just buying up smaller, struggling private credit groups?
I think it will be a mix. I think the biggest entrant that we're seeing is frankly the non-alternative asset managers who are struggling to grow, struggling with margin, acquiring higher growth, higher margin alternative asset managers. Yeah. That isn't stopping. So the Fidelities, the Franklins, that move of them wanting to continue to own assets in our space, I think is not going to stop. They need it, and they know they need it. So I think it will be that, and I think it will be sort of the merging of sort of bigger credit managers gobbling up some smaller credit managers.
You mentioned the spread differential between Wall Street and private credit, which continues. There was a bunch of stories a couple months ago about how Wall Street was kind of making a little bit of a comeback, getting into LBOs. Do you feel that story was overtold, or do you think that was legitimate?
I think it's legit at the bigger end of the market. I think if you look at the vast majority of volume, though, it's still at sort of that sort of small and mid-market end. And that's not where Wall Street's sort of spending their time.
You talked about consolidation and kind of just now about kind of non-private equity managers buying private credit. There's also been some interesting consolidation or growing consolidation between private equity and insurance on both sides. Insurance companies buying private equity / private credit groups, private equity groups either launching or buying insurers. How do you kind of make sense of that? Because private equity and private credit, there's obvious synergies. Insurance is a little bit of a different animal, much different animal.
The answer, I think, is relatively simple, which is if you're a fund manager, you love the idea of kind of permanent capital. And you love the idea of controlling a book where you get to decide where that book is being invested. And so I think the insurance angle works. I think it works for very, very large managers. I don't think that becomes a trend for smaller and mid-sized managers. So I think you'll continue to see that. But you're going to continue to see that kind of among the sort of the monsters in the industry, and I think that's where that activity will basically exist and stop.
Does Hamilton Lane have any interest in getting into insurance?
We serve a lot of insurance customers.
You serve them as clients, but I mean on the
so buying an
side.
Insurance company, I don't see that in our future. I do see what we offer has a place in a variety of insurance entities, and we do that today.
You mentioned when it came to bring retail investors in, you talked about technological advances which could help it. One of those would be tokenization, which is something that you guys have worked a lot about. Explain what tokenization would mean when it comes to private equity.
So I think it means a few things. If you sort of step back and take the big picture, our industry has changed very little over the last 30, 40 years. We're still doing subdocs. Some people still want to fax those to us. We're still doing KYC, AML. And
you still have fax machines? How many fax machines do you have?
We have more than one, which is insane that we have more than one, but we do. If you're one of the people faxing us, stop doing that. The retail investor's not going to tolerate this. The retail investor has been totally accustomed to a world where they operate on their phone. They buy stocks on their phone. They buy groceries on their phone. They're not going to come into our asset class and go, oh, great. Now I'm going to use a chisel and a rock. Great. They're just not going to do it. And so I think tokenization will be really kind of the forefront of how that changes. So very quickly, imagine a world where we go through a onboarding process that is digital, and you now create yourself a digital profile and a digital wallet that you're going to house your digital securities. That means KYC and AML is done one time. I don't have to go through that process every time I write a check. I go through that process once when I open up my bank account. That's what this world will look like. And we will simply take funds, we will tokenize them into digital securities that I can own and operate in my digital wallet, and I can trade them more freely. That doesn't change what the private equity managers are doing or investing in. It simply changes the way we're operating together. I think the retail world's going to want that. I think they're going to demand it. And so I think the change will start there, and then it will flow to the institutional world. But I have no question that that change is coming.
Hamilton Lane, a couple of years, 18 months ago maybe, started offering tokenized access to some of your funds. What was the uptake like?
So the uptake has been slow. We are really at the forefront of this. So not only have we been offering tokenized versions of our funds, but we've actually been putting Hamilton Lane balance sheet capital, not fund capital, behind some of the token exchanges. So we own a piece of Securitize in the US. We own a piece of ADDX in Singapore and others. And so we are big believers that this is where the world is going to go. But we also recognize, again, go back to my opening point, this industry has changed very little in the last 40 years. Getting them to completely rethink how it's going to work is going to take some time. Credit card got introduced in like 1950, 1960, and it took until sort of the 2000s until you had about an 85% uptake. Apple Pay comes along and went like this. We're kind of going from basically writing checks to getting people to be used to Apple Pay. That will take some time, but you will hit an inflection point and it will happen.
You've also invested and spent time as a firm working on something called Helix, which is kind of an AI assistant for private market investing. Has the uptake on that been faster?
So we're just launching it. So Helix is basically taking a Hamilton Lane kind of analytics software package that we call Cobalt that today is sold to institutions. You can go on cobaltlp.com and sort of see that. And we partnered with a firm called Tiffin, who's been a leader in kind of AI for financial services. And the two of us came together, essentially have put an AI chatbot that's very purpose-driven and proprietary wrapped around Helix with the idea of, go back to our retail question, if you want to get the retail investor into this market, you're going to have to educate them, which means you're going to have to educate their wealth advisor. And so they're going to need a place to say, what has been the one-year return? How has private credit performed when rates move? What happens? Are LBOs and private credit correlated? Right now, you can ask those questions verbally to Helix, and you actually get analytics output based on our analytics and our database. So it's really designed to try to help educate sort of the large group of investors out there that are going to need that education.
I'm curious, as co-CEO of the company, how much your history is, you kind of come from the call it chisel and rock days, negotiating with private fund managers, getting into funds, et cetera. How much do you actually understand the technology underlying the stuff you guys are now selling?
For me, if you sort of look what I've done for the last 7 years prior to taking on this job, I was the head of our strategic technology group. So for me, this has always been a part of where I have spent personally an enormous amount of time. Was on the board of iLevel when we helped create that. We were an early investor in DealCloud and helped create that. We've been a big investor in Canoe for sort of data onboard. All of those have been Hamilton Lane balance sheet. And today, I spend a lot of my time with sort of the token world and sort of thinking about those exchanges.
You mentioned this new role. You've been with the firm for about 25 years. Since taking the co-CEO chair, what, if anything, have you learned either about the firm or about the market? There's this theory, until you sit in the chair, there's something you learn you didn't realize you didn't know. What did you realize you didn't know?
You spend a lot of time with your head of HR. That's what I have learned.
It's fair. You mentioned earlier the Hamilton Lane is a publicly traded company. It's a publicly traded private equity firm. What was the basic argument for why you guys went public?
Yeah, our answer was very simple, and it was twofold. One, we had an equity culture at the firm, so we sort of did a management buyout back in 2003. And if you're going to have an equity culture, at some point you need to have your employees have a venue for monetizing that equity culture. The bigger driver, though, for us was brand. We compete with firms that are much more of a household brand than we were, particularly outside the US. And so as we were kind of competing in the Middle East and Asia, et cetera, that having sort of the imprint of being a US publicly traded company was an enormous brand benefit. Less so here, very powerful overseas, and that was really the big driver.
When it comes to fundraising and institutions coming in, I was just at Milken, 2 weeks ago, and the buzzword at Milken on the private equity side was constantly DPI, particularly coming from the LP side. And a better way of putting it was, where's my money?
Right.
We heard that a lot from LPs. As somebody who represents a lot of these LPs and works with them, where is the money? Are you concerned that you guys have been putting out cash much faster than it's been coming in?
Yeah, I mean, I think I said earlier that the hold periods are getting longer. And I think you have GPs in love with assets. If they own a great business that's compounding at double digits, they're reticent to sell it because trying to find a new asset that they can acquire today that's going to grow at double digits.
But the LPs arguably enable that by funding continuation funds.
You see both of that. But I think right now the GPs are starting to hear the drumbeat of there's no more money for you because I don't have anything to fund it with until you start getting money back. When you and I had talked a couple weeks ago, I said to you, I've never seen a fundraising logjam like what we're seeing today because people have gotten extensions. So the 2022 funds are still out there, as are the 2023 funds and then now the 2024 funds. So you have this tremendous stacking that's occurring, and it's messy. And GPs, I think, are having to kind of recalibrate what a successful fundraise is, how long does it take, the whole notion of I'm going to be a one and done. No, you're not. You're going to be out there for a while.
Are LPs actually, you say that, are LPs actually saying no, though? Because we still see large fund announcements almost on a daily basis.
You see it, and I think what you're seeing is there's a real gapping that's occurring. So there are some ultra-successful firms that are raising a lot of money, and then I can show you right now the other 1,500 folks that are kind of in the queue that are nowhere near their target, and some of them have been out fundraising for 2 years, and they're nowhere near their target.
Last question about that in general, which is, of your clients then, are they feeling concentration risk? And I, like you have a firm that's got 10 different fund families that they've just got too few managers, or is that better? Or do they feel we're more comfortable with this? We have fewer managers, we have fewer relationships we have to deal with.
What's interesting for us, our client base is all over the place. Right. So some of them, we literally have a client that we signed a month ago that has never been in the asset class before. So they have no concentration because they have nothing. And so you have that on one end of the spectrum, and there's still a lot of those people out there that have no exposure. Then on the other end of the spectrum, you've got the clients that have been in the asset class for 40 years and have hundreds and hundreds and hundreds, and they're kind of pruning and sort of adjusting, and everyone's got to deal with it.
Eric, appreciate your time.
This was fun. Thank you.
Thanks so much. We now have our final conversation day. I should tell you before we do that, there will be coffee, and not alcohol, sadly, but there will be coffee and snack stuff outside after we are done, so please hang out and talk with each other. So what we're going to do here is we're going to switch Erics. I want to welcome from EQT, Eric Liu. Hey. For those who don't know, you're at EQT. You run North American private equity. You run healthcare investing for EQT. Going into the year, the conventional wisdom on private equity, particularly in North America / the US, was we're going to get a lot of rate cuts, and because we all believe we're going to get a lot of rate cuts, deal making is going to go way up. I read that everywhere. What's happened instead is no rate cuts, yet deal making has gone way up. So if the rate cuts didn't happen, why has deal making gone way up?
Yes, I never thought that the rate cuts were really going to impact deal making. I mean, one rate cut, two rate cut, three rate cuts. If interest rates are at 5%,
4 rate cuts, 5 rate cuts,
4.75, it doesn't really impact the private equity rates of return. I think what was happening for a period of time is when they go from 0 to 5, then people go, oh, well, maybe the models don't work anymore. But I think small deltas relative to 5% don't really impact deal making.
Does the private equity model work at these rates? As you say, so say there's 1 or 2 cuts, but they're just around the margins. Does the model, generically speaking, work?
I mean, for sure. If you think about, I've been working in private equity since 1998. If I think about the median interest rate that's existed for most of my career, it's probably, 3.5%.
How about the median interest rate that's existed for most of your employees' career?
Well, that's different. But if you think about where private equity returns are generated, there's basically 3 types. You can grow earnings, you can get multiple expansion, or you can pay down debt. Right, and so, but if you think also over the longer term about how the industry has evolved, when private equity first started, it was essentially mispriced securities. Like, this thing's kind of boring, it trades at 4 times EBITDA, no one wants to own it. Hey, guess what? If I borrow 95% and put a 5% equity cushion in, I can make a ton of money.
Yeah.
Right, and then the equity percentage started going up. Maybe it's 20, 25% by the time I started my career. But today it's a mature institutional asset class. Lots of competition, lots of targets also. So the concept of explaining to somebody why there should be a private equity deal, we had to do when I first started. Now you don't. But if you can actually make a company better over time, that's where we generate the majority of our equity returns.
When you talk about the majority of your equity returns, the thing I ended with Eric on was this question of DPI and the relative lack of return. So I won't ask about it. So here's the problem. So I would have these conversations with folks like you when I was out in LA, and I would hear the following: yeah, nobody's returning money except for us. So I'm going to ask for the except for EQT part. Given the stuff you said, why are firms returning less? In part, as you said, there's a lot of buyers. There's other private equity firms that should want to buy these assets.
Yes, so if you think about when I started in the industry, you'd underwrite things to 5-year returns, 25% IRR, 20% equity. If you think about making 2.5, 3 times your money on a deal, you either had to buy really cheap, you had to generate a ton of cash, or the multiple had to expand.
Yeah.
In the last few years, people have been exiting things in 2, 3, and 4 years. Like, you can't do that when you're not getting multiple expansion anymore. So it makes sense that things are reverting back to longer holding periods.
Is that all it is? Do you think these are just longer holding periods? Because you've got some things that have become extraordinarily long holding periods. You think that's all this is, just a reversion to the mean of holding periods, as opposed to private equity firms desperate for that bigger hit, and they're just waiting. I mean, continuation funds sometimes are for assets that have been well longer than 4 or 5 years. You're talking decade.
Yeah, I think 5, 6 years. I mean, like I said, the mean I would say is 5 for most private equity firms when they do the underwriting model. It's only been a recent phenomenon that people have been able to hold things 2, 3, and 4 years, and that's because multiples are expanding. When they're flat or maybe contracting, you're just going to have to hold assets longer in order to generate the same multiple of investment. You talked about when you started your career. Let me ask you: you've had an interesting career in terms or interesting career arc when it comes to private equity standards. You start in private equity, then you go to the Valley to do venture capital, and you come back to private equity. What, if anything, did you learn in venture capital that you were able to apply to private equity, if anything? That's a good question. So when I started in private equity, it was '98. The debt markets actually crashed, I think, the week I joined Blackstone. And Blackstone's a pretty tough place to work. Very thorough, very disciplined, very analytical. And then meanwhile, these guys in Silicon Valley were investing $7 million and turned into $2 billion. And I was like, well, that seems pretty interesting. So I moved out there. I think I got my job offer in March of 2000. And I started my job in July of 2000. And I was there for 2 years. And then I was at business school for 2 years. So I think I was in Silicon Valley.
So you were part of the group that got the hell out of Silicon Valley and applied to business school because things were going poorly?
Well, no, I was there during business school.
Oh, okay.
I think I was in Silicon Valley the only 48 bad months over the last 5 decades in Silicon Valley. I was like, this is terrible. Like, the market's never going to come back. And there were all these buildings going up on Highway 101. I was like, that's never going to get filled. That's never going to get filled. And the thing I learned is that, markets come back. And you can't quite explain why. Things go bad. In fall of 2004, when I came back here, there are all these empty buildings. The market, I think the NASDAQ was at 5,000 when I got my offer, 1,300 when I joined, and 1,100 when I left the Valley. And I was like, this was terrible. But people are very entrepreneurial in this country. People like Facebook was invented when I was out there. Google went public shortly thereafter.
You didn't invest in it, huh? Facebook?
No, it was that. No. Well, my friends rented their house to Mark.
Oh.
Right? They needed a few months of rent subsidization. But the thing is, it's amazing. People are very entrepreneurial here. The capital markets are very fluid. Things can go bad, but things also just come back. And there was no particular catalyst. I can't point to anything from that time that would point to the market coming back that quickly or to the depth that it did. And so, when things look bad, they tend to get better. And when things are good, they tend to go the other way. Markets are cyclical.
Well, so when you come back, you go to Warburg Pincus, you end up at EQT, and you start at Stockholm, correct? At EQT, which is where the firm is based. What is, for those who are here, who I'm going to guess for the most part are US-based investors who have mostly lived here, mostly worked here. Culturally, you still work at EQT, but you're here now. Culturally, what is the biggest difference between the office in Stockholm and the office in New York?
So the funny thing about EQT is that it's a very culture-driven firm, just generally. It's a very different culture than most other private equity firms. The thing I always tell new hires when we're meeting them is the firm's sort of maybe a third like a financial services firm, maybe a third like a startup company, and maybe a third like some sort of nonprofit organization that's very mission-driven. So the culture is very different. How we go about things is different. The types of people we attract.
You don't call yourself nonprofit when you're pitching your funds, do you?
I always say mission-driven.
Mission-driven, very.
It's a very mission-driven firm. Like the firm, Sweden's has a different culture than the U.S. And so I think
was it hard for you though? You'd come, as you said, Blackstone, then Sojourner the Valley, but then you're Warburg in the U.S. Was there any culture shock when you walked into the office in Sweden?
Well, the thing about Sweden that's interesting is they look like Americans, right? It looks like a lot of people that I live with in Connecticut, but it has a very particular culture. It's very transparent, so everyone sees everything. All investment committee calls are open. In Sweden, you can call the IRS in Sweden and ask for your neighbor's tax returns, and they'll send it to you. But then they'll tell your neighbor that you asked for them. So every year in Sweden, they publish a list of the top 50 taxpayers in the country. Everything's completely transparent, which is very, very different for most US-based private equity firms.
Which actually, it's interesting because one of the things that EQT used to do but doesn't do anymore is used to publish very high-level financials for portfolio companies. I remember your website used to be Portfolio Company X, EBITDA last year. Yeah. When did you guys stop that and why? I loved that as a reporter.
So when I joined, I saw that. I was like, do we really need to be that transparent? And I said, we're EQT, we're transparent. This is what we do. And I said, but the problem is sometimes there's a lack of context, right? So being transparent without providing all the context is actually not being transparent.
Right, so what you should have done was provided all the context. The entire financials, maybe an executive summary.
So I actually don't remember when we stopped doing that, but a few years ago I asked, I was like, hey, do we still do that? And they're like, no, we don't do that anymore. I don't know when it went away, but that was very important to the firm, or the firm's cap table.
Yeah.
If you go to the website, you can see the list of what all the partners of the firm own in terms of shares of the firm. If you have carry in the fund, everyone knows what everyone else's carry stake is. It's very transparent.
So you run North American, other things too, but North American private equity for EQT. And EQT raises a slew of different types of funds, but you also have kind of the flagship funds. You guys just closed on like 22 billion euro, right, for the most recent one. How do you, are there actual geographic allocations, or how do those conversations work? Does somebody say, hey, Eric's been taking way too much of the money? How do those conversations work from a geography head standpoint and how you split things up?
Yes, if you think about the history of our firm, so when EQT was first founded in 1994, a lot of European private equity firms had everyone sitting in London, and they would fly to different countries. Right. Or maybe they'd have everyone in London, but one was French, one was Spanish, one was Polish, or whatever countries they wanted to invest in. EQT started what we called local with locals. So we have pretty large offices in pretty small countries. So Sweden, Denmark, Norway, Finland, Germany, all these places that have fully built out offices. Because the idea is there are not that many deals in any particular country at any point in time. But when there is one, it's very, very easy for us to do it because we've been tracking the company for 10 years. We know everyone there. So that's what our investors invest in. It turns out over time, we also developed an expertise in healthcare. So healthcare is about 40 to 45% of what we do. And so now when our investors look at us, they want exposure to Northern Europe, they want exposure to healthcare. So within the US, we've been mostly focused on healthcare and then also a little bit of tech. And so healthcare, I would say, the US is about 35% of our fund, probably for this one.
When you say for this one, that's the expectation. I mean, that's the expectation.
That's the expectation for Fund 10.
For Fund 10. Okay, for the one you just closed. If somehow you guys realized you were tracking to say 50% or 10%, would that raise bells inside or would it not? People would be like, well, we're doing better deals in London and that's just how it is right now.
Yeah, I think for our firm, so our portfolio tends to be pretty concentrated, let's say 15 to 20 deals per fund. Every time we make a new investment, we say, okay, here's what the portfolio looks like now. If we do this, here's what it'll look like on a pro forma basis. And so we kind of will manage the portfolio a little bit as we go along. It won't just suddenly end up in a way that it's not supposed to be at the end of the day.
You mentioned the U.S. concentration, the interest in healthcare, and you're obviously in charge of healthcare private equity too. How concerned are you about regulatory risk in the U.S. when it comes to private equity healthcare investing? We obviously have seen kind of the Welsh-Carson lawsuit with the FTC. I know Welsh itself was excused, but the company, the portfolio company wasn't. They're still under antitrust. How is that taking up brain share or not right now?
Yes, I think regulation is part of life in private equity. I think regulation is part of life in healthcare.
But it seems more so now. Those two things seem to be getting combined, at least by the Biden administration.
They're combined for different reasons. So one is that the industry's gotten larger and more institutional, and so therefore there's more regulation generally. I think healthcare specifically is a different matter. It's that healthcare and education are two sectors where there's a lot of nonprofit players, and if you talk to people out in the public, it's like, well, I don't know, should people really be doing that? And so you have to be a lot more careful when you're doing for-profit investments in the healthcare sector. The sector that we've specifically avoided, though, are healthcare service providers. We don't invest in hospitals, nursing homes, dialysis clinics, anything that's taking patients, doing something to them, and then collecting money directly from the federal government. I think those types of business models tend to be under a little bit more direct regulatory pressure.
So is that the main reason, the regulatory pressure, as opposed to the reimbursement side of it?
Well, there's a few reasons. So one, it's regulatory issues. I think second, frankly, is media and PR risk, right? If something bad happens, people are, if you have some people, 90-year-old, or your average customer, some of them are going to die in your facilities.
Yeah.
But like that's not good. And so we try to avoid those businesses because it's too easy for somebody to come up with a story saying, hey, look, such and such happened to Annie when she was in such and such facility owned by private equity.
Yeah.
And you can't really defend.
So the headline here is EQT tries to avoid companies in which its customers die. Got it. That's a good business model, I guess. It makes sense to me. I'm curious, we talked about that $22 billion flagship fund, but EQT does have this huge family, right? You have infrastructure funds, you have mid-market funds, you have geographically focused mid-market funds. Eric Hirsch and I was just talking a little bit about kind of consolidation, big managers. You guys are part of that trend, right? Raising more and more. Is that good for the health of the industry, big picture, that we kind of are getting much more? It's not even a barbell. It's really whatever a barbell missing the other thing is. Is that good for the industry? Is it not good for the industry? Big picture, again, taking EQT out of it.
I think it's definitely good for the industry. And you see it when you make individual investments or you see it when some of your firms go raise funds. If you think about the private equity industry, it's essentially a blank check industry. It's like, I'm going to give you $20 billion to invest in whatever you want, whenever you want, with no oversight from me directly. Yeah. And so as the sums get larger, you really want to be giving money to institutions that have longevity beyond whoever the founder is. So I think if you're going to invest at scale, having the institution be larger, more regular, and also be able to deal with the regulations that are coming out. There's a lot of stuff that we do as a firm that you can only do if you have that scale that are actually quite important to the investments and quite important to the organization as a whole. And we can also do training. There's lots of things that we do for our employees that only scaled organizations can do, which I think is better for the investors.
Let me end with this. Let me ask about your employees. When Lynn Martin was up here, we talked a little bit about AI, and I made the joke that my mother asked, do I still have a job? So let me ask this from a private equity standpoint. Hell, you have a portfolio company that just did a deal with Palantir to kind of bring AI into clinical trials. Within EQT itself, not just how are you guys using AI, but is there a long-term concern that so much of this business is an apprenticeship model? That's how you did it. And that there's going to be less need for those young analysts who will, in theory, someday should be the head of North American private equity for EQT. They just won't be there. There's no pipeline.
Yeah, so somebody asked me that last week, and I was like, it's really funny. If I think back to when I was an analyst and what I was doing, I had to print books, I had to label the page numbers, I had to put them in cars, I had to send faxes, I had to track the fax machine.
God, faxes again.
I had to call the library and get 10Ks for companies, and I'd have to wait a few days, and I had to spread all the numbers. Our guys don't do that, but yeah, we have a lot of associates. The bar keeps elevating in terms of what people are expected to do. Our guys don't print books, our guys don't send faxes, but if you're looking
But they do a lot of modeling that they might not need to do soon.
Yeah, but the modeling that they do is much more advanced than what I did. So I might find out, okay, what is this company trading at today? That's interesting. What are 5 other companies like that trading at today? With our guys, they have to look at all 20 of them, and they have to look at how it's traded over time. They can produce that in a day. and you can drive a lot better insight from that. So the bar in terms of what the junior people have to do keeps moving up, which is why you keep having that layer. And so that I think the concern you're raising, at least it hasn't manifested in the 25 years.
Do you think we get to the point before your retirement that deal negotiations are being done by bots and not by people?
Well, that's the other thing that's interesting about this industry. No matter how AI, it's still a very, very relationship-oriented industry. I mean, I think one of the
Right, but bots can have relationships as we're learning. No, I'm not kidding. They can. I don't mean it the way that sounded. But I mean in terms of basic diligence in those conversations. I mean, a lot of that in theory could get automated. The better these technologies get.
Yeah, but the trust doesn't get automated. So I'll actually give you a perfect example. We just bought a company called Avetta recently. We bought it from Welsh Carson. Welsh Carson had a ton of interest in the company. About a month before we were due to bid, I called Scott, who runs Welsh Carson, up, and I said, look, we want to own this. I've known him for years. He was in a prior investment with us. And I said, we will get there. You just let us know what we need to do. They got a bunch of bids, and he said, I'm going to make one call. He called us and said, look, here's what you need to do. We said, fine, we'll do it. He wouldn't have done that if it weren't me or somebody else that he hadn't known for a very long period of time. And so that's why that doesn't get automated away.
Eric, that is where we're going to end it here. Just quickly for everybody to know, our next big private equity / deal-making event will be in New York City. It is the Axios BFD New York City, which I think we just announced, which will be October 22nd. If you're interested, I'm sure in tomorrow's newsletter I'm going to mention it, and there'll be a link. Also, if you don't get the Axios Pro Rata newsletter, please do so. It's getprorata.axios.com. Thank you all for joining. Coffee, drinks. Eric, thank you.
Thank you.